Hey everybody, how's everybody doing? Uh, First thing I'm going to do is just make sure the sound is good. So type in to Marco, let him know that you guys are hearing me okay. Um, we'll give it a few more minutes for everybody to come into the room because I see we just um, have a few stragglers coming in here. So I want to make sure that everybody comes in before we start the webinar. But is the sound good, Marco? Is everybody hearing me okay? Okay.
Yeah, perfect.
Okay.
And everybody can hear you okay. Yeah.
Okay. That's fine. That's fine. Okay, awesome. Hey everybody, this is Boris Schlossberg with BK Forex and Pepperstone. Welcome to our monthly webinar series. And this month, the webinar that I wanted to share with you is actually very unique because, typically I always talk to you about strategies and ideas and charts and indicators and all sorts of things. Um, and this webinar is going to talk about none of that. And yet, I think it's probably the most important piece of information I can impart on you because everything I talk about in this webinar actually informs all of your strategies, applies to every idea you ever trade, and is generally the structure and the foundation for how I think you should be doing this business. I've taken these lessons to heart myself. I do this myself. And as a matter of fact, I'm going to be doing a master class for everybody in BK this Saturday. A huge part of there's going to be a million strategies, but a huge part of the structure is going to involve the concepts that I want to share with you here today. The name of the webinar is called Uncovering the Secrets of Leverage. And first of all, as always, past performance is not indicative of future results. Trading Forex carries a high level of risk, might be suitable for all investors. High degree of leverage can work against you as well as for you. So we're going to just talk about that in real serious detail today. Before deciding to trade any such leverage product, you should carefully consider your investment objectives, level of experience, and risk appetite. And the possibility exists that you can sustain a loss of some or all of your initial investment, and therefore you should only invest money that you can afford to lose. You should be aware of risks associated with trading on margin and seek advice from an independent financial advisor if you have any doubts. So feel free to read the rest of this disclaimer, but it's very, very apropos to the lessons and the ideas that I wanted to share with you today. So before we talk about the broader, more interesting aspects of leverage, let's review the basics. Let's take a look at what is leverage. Margin, which is kind of interspersed and interchangeably used with leverage, is, think of it essentially as a good faith deposit, right? Whenever you're dropping money into your account, it's actually called margin. That's your equity. And what that is basically it's a good faith deposit to control a much larger sum of a financial instrument. So a simple example here, 100-to-1 leverage, very common across most of the globe. Some areas have higher, some areas have lower, but that's sort of, I think a midpoint globally of where leverage regulations are. It basically says that you only need a $1,000 deposit to control $100,000 worth of a financial product, whether it be currency or CFD. And I'm gonna, today, because I'm an American, so we don't get the luxury of trading CFDs. We only trade FX, so all my examples is always are going to be just FX, but they are 100% applicable to all other financial instruments. I don't want to get into the technicalities of CFDs because there are other costs and aspects of CFD financing, but the actual sort of the idea, I drop a small amount of money, I get to control a large amount of money. That's a concept universally applicable, whether it be FX, CFDs, any other financial instrument. So that's margin. Margin is just a good faith deposit that controls a much larger the ability to control a much larger amount of face assets, right? So I drop $1,000 and now I can control 100,000 euro dollar trade. Let me just make sure everybody's good with that. Does anybody have any questions? I'll give you a second, Marco. If there's any questions, feel free to just read them out loud to me.
Yeah, not for now. Not for now. We can go on.
Very good. Okay. So it's an inverse relationship between margin and leverage, right? The larger the deposit, the smaller your leverage. Let's just sort of go in here and just assume. Let's say you are required to drop $2,000 to control $100,000. Then your leverage would become 50 to 1. It would be halved. So it's, as I said, it's a inverse relationship. The larger the margin, the smaller the leverage. The smaller the margin, the larger the leverage. Now, of course, all traders in the world love this particular combination. I want to drop a penny and control $1 million, right? That's our favorite way of doing business. I want to drop a penny and control $1 million. But that is a dangerous, dangerous attitude to have, and almost never the right attitude to have. So I'm going to explore with you why sort of the smaller the margin, the larger the leverage idea is not necessarily to your best interest. So here's how the basic ratios work. $1,000 1-to-1 margin means that there's no leverage, where you cannot borrow any additional purchasing power, right? That's a 100% margin. 1 to 50, where you drop 1,000, you get to control 50. That's 2% margin. 1 to 100,000, 1% margin. Then it goes down. And really, this is a table that I think is very indicative of like the most extreme to the least extreme lever factors across the world. And there are plenty of places. I think Australia. I'm not sure, but I believe Australia actually has this margin, right? So most of you guys have the maximum amount, which means that you literally can drop a quarter to control $100, or $1,000 will allow you to purchase $400,000 of Eurodollar at one clip, which is massively levered, right? Another way of thinking about this, by the way, is kind of interesting, is if I only put down 25 basis point is 1/100th of a percent, right? So 25 basis points is this, 0.25%. Another way of kind of thinking about this, really, I think, brings it home, is if I just put down 25 basis points to control a trade, if a trade goes down by 25 basis points, I'm completely wiped out. Meaning that if all the trade has to do is go down by a quarter of 1%, 25 pips effectively for a lot of these pairs, and I'm just my whole account is wiped out, right? Whereas over here, the trade literally has to go to zero. Aussie dollar has to go from 72 cents down to 0 cents before I lose any money. So somewhere between here and here is a happy medium that we're going to talk about. But understand that's kind of how the dynamics work. Is that clear to everybody? Again, just want to make sure that you understand. If this is how much money I'm dropping, that means that if the actual value of my trade drops by just this little amount of money, my whole capital is wiped out. Is that clear to everybody? So I'm going to take silence as a yes, and if there's questions, Marco will chime in and he'll read them out to me. Okay?
Yeah. We have one question.
Okay.
The question states, it's up for you, and says, Boris, what do you think is the best leverage you can get by trading forex on majors on a day strategy?
I'm trying. Let's clarify that question. By the word best, do you mean what is optimal, or do you mean what is the most leverage that you can get? Because
I think it meant optimal, yeah.
Optimal leverage. Well, that's going to be the conversation that we're going to have. So I'm leading to that. So I promise you, I will give you the answer to that, and I'll also give you the answer to what I think is the optimal leverage for longer term trades and stuff like that. So I promise you, yes, I will. This is the whole point. I'm just going through the basics here. So for a lot of people, because I really want, I know for a lot of you guys, this is very boring, and you already know this stuff. But there are people who don't know, and I really want everybody up to par, because if you understand the fundamental questions, and honestly, a lot of times we all know this stuff, but sometimes you don't quite understand the fundamentals. If you understand the fundamentals, then all of the strategy becomes a lot easier to absorb. So, anyways, anybody watching cable? Wow, cable on 27 bid. Leverage is very much a two-edged sword, right? When you're right, it's unbelievable. You could literally take $1,000 and double it in a day, right? Or the flip side of it is you can take $1,000 and lose it in a day. And of course, it gets even better. You can take $10,000 and double it in a day, or you can take $10,000 and drop it in a day. So it has huge opportunities, but also huge risks. And my goal with you today is to make you sort of, one, understand the risks, and then see what are the most reasonable opportunities we can use for leverage. So here's a chart that kind of explains this this value. And by the way, I'm certainly going to send this presentation to everybody. I'm sorry, Pepperstone already has this presentation, but I'll send this latest version to you guys up there, and maybe I believe they always can convert it to PDF, and anybody who is attending this course is going to be able to get my presentation. So all of this stuff, I think it's actually valuable for you to have this as a PDF, as a reference source. A long time I use it myself sometimes as a reference source. So this is one of the more referential presentations we have. So hopefully you'll all be able to get it after the course. Here's the power of leverage. At around 200 to 1, $1,000 controls $200,000, and 1% profit, you make 200% on your money. That's what I was talking about, right? So euro goes 100 pips, and that's not quite 1%, but I'm just using a shorthand. Then the more accurate thing probably would be, say, if dollar Swiss goes 100 pips, you make about 200% on your account. So you really have this incredible power at your fingertips, but you also obviously have this huge risk. I've used this chart before a lot of times, and it's just startling to me. I've had this chart for more than a decade, and it never fails to just astound me at how brutal it can be if you're wrong. So let's say you are you're not even day trading. Let's say you're swing trading. You're swing trading, right? And your typical loss on a swing trade is about 1%, right? It is very possible, even if you're having a good year, to have 5 losing trades in a row. Especially, and this is the thing, if you're trading, let's say you do a swing trade every day for about 100 pip, target, right? It's very possible, very likely. That means there's a 250 trading days in a year that you're going to lay down the trade. Very, very likely that you will run into a bad streak. I mean, look at last week and a half in cable. It's just been rip up, rip down, right? Any kind of headline risk. Look at Aussie with U.S. China conflict. A rip up, rip down. Me and everybody else that was stupid enough to sell Aussie at 71 got their face handed to them when the thing completely reversed and the market shrugged off the trade war fears. So the point is that it's not almost a guarantee, but it's a high degree of certainty that you're going to hit 5 losers in a row, right? It's not uncommon. I mean, I'm actually curious. Have you guys had? Feel free to chime in. Have you guys had at least 3 to 4 losers in a row over the last 60 days? Have you had a string of trades where you just had like three consecutive? I certainly have. Hand up, right? So if you've had more than 3 to 4 losers in a row, this is really important. because if you take a $10,000 account, and I'm using, obviously you guys can translate for euros or Aussies, but I'm US based, so I'm going to use dollars as always my reference point. But I start with $10,000. And all I'm doing is trading 10-to-1 leverage, like the most, what most people consider to be incredibly conservative leverage, right? We have 100-to-1, 400-to-1. We have huge amounts of leverage open to us, right? And we're just going to take a 10-to-1 trade. I'm going to take $10,000 and buy $100,000 worth of product with it. And I'm going to lose 5 times in a row, which is not uncommon. And by the end of that week or by the end of that month, my $10,000 is now down to $6,000. I burnt 40% of my money. Now that's horrible from every possible angle. It's horrible, most importantly, psychologically, because now I'm beaten. I'm beaten to death. I'm like, Jesus, I lost nearly half my account. How am I ever going to get it back? The first thought you have is, how am I ever going to get it back, right? But it's also horrible from just the pure physical aspect of it, because now I have a lot less resources to make trades, right? If you think about your money as just essentially resources, right? And if you think about wealth as just the ability to have more and more resources, then the less wealth you have in your account means the less resources you have to operate. I can't make more than 2 or 3 trades. I can't do this. I can't take advantage of this trade because I'm in this other trade. It just completely constrains you, constrains your operating ability. The more you're constrained, the more difficult it is to come back. So you have both the psychological hit and the physical hit when you drop so much money on something that is literally occurs almost all the time, which is basically losing 5 trades in a row, right? Now, conversely, if you go to the complete end of the other spectrum, right, I'm only down $500. It's nothing. It's nothing. I literally have pretty much all my, I have 95% of my resources at my fingertips. I can operate with as much freedom as when I had 10,000, right? I'm not as I'm annoyed, I'm pissed, but I'm not psychologically damaged like I would be in this particular situation. So literally 5 losses in a row at a very, very modest 10-to-1 leverage puts you in a hugely disadvantageous position. Let me just stop here, make sure everybody absorbs this particular slide, and Marco, you let me know if there's any comments there.
Yeah, I mean, we have 3 or 4 people who said it's not uncommon to have 4 losses in a row, so that's about right. And yeah, we have a couple questions. We have one that is actually not about leverage, but it's pretty interesting, I'd say. It reads, yeah, cable looks crazy. Do you think it's sustainable, or will it come crashing back down? The joy of the Brexit saga.
So we'll do a little market commentary. We'll do a side commentary. Nobody was a bigger skeptic of Brexit than me. Here's my point. The short answer is I think cable has more to rally. It feels like the Europeans want to make a deal, and the Brits don't have a choice but to make a deal, right? There's always a danger. Cable is just an insanely unpredictable country and currency at this point. There's always a danger that they could decide to just kamikaze themselves and refuse to. It all comes down to the Irish border, right? Really, what are we talking about here? Everything else is fully negotiable, which is unbelievable. Like Britain is getting away with murder. It's going to get pretty much good access to the market and everything else. All they have to do is simply not have a hard border, meaning no border guards, just maybe a bunch of cameras, and people can walk back and forth, and it's all sort of monitored in a non-intrusive way. If they agree to that, which I know the idea of sovereignty is really becomes a big issue for the hardcore Brexiteers, but that is really, it's like 75% of people in UK will probably say that's just really not a big deal. Let's do it in order for us to have access to the market. So yeah, I completely changed my mind. I used to think that this was incontrovertible. I thought the Europeans would be much more hard-nosed about it, but they've just sort of given up and they've said, okay, screw it, let's just do a deal. And if that's the case, then I think yes, it looks like they're going to try and do a deal. And UK economy is running a little bit hotter now. So it seems to, monetary policy seems to be a little bit more aggressive than it is on the European front. So yeah, I mean, do I think cable can go to 30, 35? Absolutely. But I leave it with a caveat that if there is if, nobody has snatched more defeat from the jaws of victory than the British. So there's still possibility for a blow. But I think the main point that you're asking is, has sentiment shifted? The answer is yes, and that's what I think you're seeing in the price. So that's my market commentary for today.
Okay. We have another question on leverage.
Yes.
So it reads, why do you think such high leverage is being offered by brokers? And what kind of players in the Forex market can successfully trade at such high leverage, for example, 50 to 1 and up?
So the idea of leverage actually goes, it's not something that brokers just invented. It actually goes all the way back to the beginning of the currency market. Remember, the currency market is a speculative market, right? And the currency market, if you think about this, is actually incredibly boring, right? If we move one penny, 1%, that's a huge day for most of us, right? Euro goes 100 points. When was the last time Euro went 100 points? When do you remember? Euro goes 3 pennies, 3%, maybe once a year when Draghi just decides to drop a bomb, right? So because the underlying asset is actually is non-volatile at all, very, very steady, and thank God it is, because believe me, if it was a lot more volatile, we'd all have a lot more trouble. The banks who originated the whole business, right, were willing to assume more and more risk. They said, they were dealing with institutional hedge funds and traders and corporates, and they were saying, sure, you can borrow 100 to 1 on this position because I know the thing's not going to move more than 1% one way or the other. So a huge part of the reason why the Forex market has such high leverage is because it actually moves very, very little. But it doesn't mean that it's not dangerous. And it's the same thing, by the way. Futures have a huge, in the U.S. we have futures, which is kind of like a version of CFDs. They also have large leverage. Any kind of a speculative market is going to have large leverage because of they want people to obviously speculate on it, and the more ability you have to speculate, the larger the market is. You basically, the whole idea here is you can assume large positions with a small amount of money. That creates a very large market for everybody, and so that a lot of prices get done at a lot of flow gets done at good prices. And of course the real reason for that is currency market now does what, $5 trillion. It's the single biggest market in the world. So what I was going to say about sort of the volatility is, if you go to equities, it's completely normal for a stock to be up 10% or down 10% in a day on a piece of news, right? It's completely abnormal, unless you're the Turkish lira or the Argentinian peso, for that to occur in the currency market. So that's why leverage is so high in the currency market. So this goes back to my idea of the psychological pain of being down a lot of money, which is that the mathematics really make it hard, right? You lose 25% of your money, you got to make 33, not to make any money, but just to get yourself back to your original value, right? You lose 50, you got to make 100. You lose 75, you got to quadruple your account, right? And this is why it's so disheartening to me. This is what happens, and this is the single biggest shame, in my opinion. What happens to a lot of people is they very quickly get to this point, right? And at this point, they kind of like, I want to battle back. Maybe I can make more money back, and then they start slipping. And if they get to this point, they really just kind of walk away from the Forex market altogether, right? And because they know the recovery is hard. And when they get to this point, they just pretty much close out the account a lot of times. Now and that's like 70% of the people, right? And then there's like maybe 30% of people who are stubborn and say, you know what? I get to this point, I'm going to drop another 100%. I'm going to refund my account and try it again. The thing about trading the thing about trading is like with everything else, it requires huge, huge, huge amount of trials, huge amount of practice. And if if you lose everything in the first week or the first month or even the first quarter, you get disheartened. You don't practice. You don't get good. If you walked away after the first time you drove a car, right? Let's say you drove a car and you really sucked at it. You couldn't put it. I'm gonna really disclose my age here by talking about the fact that you couldn't put into a gear shift. But anyways, you couldn't make a turn. You couldn't parallel park. If you couldn't parallel park the first time you parallel parked and you said, I'm never going to parallel park again, would you think that's a healthy way of living? It's not, but that's what happens a lot of times. It takes 100 times before you can parallel park properly in New York City. Anyways, that's my point. So that's why it's so important not to try to get yourself down to that level. And so what's interesting is that this is really borne out actually by hard data. There are lots of analysis of broker accounts across multiple retail brokers in the world. And what they found, and this is really, really interesting, look at the correlation. Winning percentage, the lower your leverage, the higher your living winning percentage. You're above 50% at 5 to 1 or lower. And then you start to drop to less than 50% at 25 to 1, right? It's actually not that bad. I'm actually surprised that you can win half your trades at 25 to 1. But still, the point being is that the positive expectancy zone is underneath 25 to 1, which is really good. This is really good because let's keep this number in mind because it's really going to come into play to what I want to talk to you about. So, okay, so everybody got all of my data at this point, right? Where we're at, how much it takes to recover, the history of successful traders on lower leverage. Any more questions, either market-based or leverage-based, before we get to the?
Yeah, we had a question on leverage. I think you answered it, but maybe I'll just read it to you. It
Sure.
reads: large amounts of liquidity means that currency volatility dies.
Large amounts of liquidity means that currency volatility dies. Okay, so the answer is yes in a philosophical sense and no in a practical sense, because what I think the assumption in that particular statement is that you will always have, let's say today I had $10 trillion worth of liquidity in the marketplace and euro moved 25 basis points, 25 pips, right? So we had no volatility. And you say, well, look at the market, last 10 trading days or last 100 trading days, the euro volatility has been 40 basis points up and down. We've had no movement. There's been like 10 trillion, $20 trillion worth of flow every day. The markets just have no volatility. There's so much liquidity, right? And this is the very false assumption that everybody makes, that just because there was 100 yesterdays that did this, that there'll be 100 tomorrows that will follow that path. All it takes is some piece of news and everybody walks away from the table, right? Think of it like, when you're in a casino, there's 1,000 people, at a poker table, or 1,000 people at a blackjack table, and there's lots of liquidity. Everybody's betting, and there's weeks and weeks and weeks of this going on. And then one day, some guy comes into the casino and drops a stink bomb, right? Like drops some kind of a smoke bomb inside of it. I'm not going to make this a violent example. I just want to give an example. And everybody starts coughing, and all of a sudden, all tables are empty. All of a sudden, there's no liquidity, right? Now, if you were projecting revenue for the casino, you're like, look, for the last 100 days, we did $1 million a day in revenue. We're going to do $1 million a day in revenue for the next 100 days, right? And no, you're not. You go from $1 million revenue to zero revenue because liquidity disappears. So the answer to that question is yes. The more the more leverage, the more liquidity there, the less volatility. But none of it means anything about volatility tomorrow. So hopefully that answers the question. That's always the easiest fallacy that everybody falls for. Which brings me to here, which basically the whole idea here is, I operate on the idea that you never know what's going to happen. Always assume the worst is going to happen. So how do we protect against, assuming the worst is going to happen, and yet at the same time take advantage of this incredible leverage that we have in this marketplace. So, they used to, when I was a young broker on Wall Street, we used to have this expression, have a hunch, bet a bunch, right? Which is a very common way of, hey, I think this is going to work. Let me just put all of my net worth into this idea and see if I can double my money, which is really how a lot of traders pretty much make their trades. Even I occasionally will still guilty of that, although I'm much less so now. I have a little more discipline. But if you have a hunch, bet a bunch, right? How can you optimize your best impulses and minimize your worst instincts? So here's an idea, right? So this is actually protections for those of you who are under the European regulator, under the ESMA regulator, right? I think I'm pretty sure that there's very similar protections in the U.S. I'm not sure what the other regulators is, but the point is, I want to just simply use this as an idea for a strategy. The main essence of the protection of the code here in ESMA is that you have a margin closeout protection and you have a negative balance protection. You see these two things that I have my arrows on? That's the only thing you really need to focus on. Forget everything else. These are the two things that are really useful to us as traders, because here's an idea, right? Negative balance protection, 50% margin loss mandatory, meaning that you put $1,000 into your account, and if the market value, the current market price makes your account worthy of $500, right? $500, then you're automatically stopped. You're automatically taken out of your account. Your account is closed out. The position is closed out, right? So let me just rephrase myself. If you drop $1,000 and now the market value of your account is worth 500, the whole account is closed out, and now you just have $500 of cash. There's no positions. It's automatically liquidated, right? And if there's some kind of a big move, and let's say the whole $500 is instantaneously gone because there's a jump in prices from euro goes from what are we trading at, 117 to 110. Just like, let's say there's a 700 pip drop. There's nothing in between. You couldn't do it getting down. It just completely does. You have what's called a negative balance. So you put 1,000 into your account. It cannot be worth less than zero. Those are hugely important, valuable protections, right? The 50% margin loss essentially acts as a stop loss. So here's a question. Raise your hand and be honest with me. This is a question to the group. How many of you in the last week, I'm not even going to make it hard, in the last week, placed a trade in your account that did not have an automatic stop loss attached? I'm going to just say yes, and Marco is going to tally up the yeses for me, and I'm going to be interested to hear, because so many of us, we're on MT4, we're now on our iPhone. Boom, I like the euro, I bought it, right? Well, great, you bought it, right? Now you're watching it, but what you're doing is you're just kind of floating it without any protection whatsoever. So if in that instant Barnier says we're never going to do Brexit, and Europe is going to default on all of its bonds because the Italians are crazy, boom, your money is gone, and it's gone. You ever see that Simpsons cartoon? It's the greatest cartoon about the great financial crisis, where the guy drops money into the bank, and like 5 seconds later the bank goes, and it's gone, and it's gone, and it's gone. That's how it can be if you don't have a automatic stop loss. This acts for you without you doing anything. This basically makes sure that you preserve at least some of your money, because it does a mandatory 50% margin cut as it goes along. So how many people, Marco, tell me, how many people have placed a trade without attaching a stop loss in the last week? Anybody vote yes in the room?
There's a couple yeses, there's a no, and there's another one that enters the stop loss after 2 minutes he entered the trade.
Okay,
and
well that's
another yes just came right now.
That's it. You're a better man than I am. That you have this of 2 minutes. I have to rely on MT4 to put all my stop losses in. So here's a high risk, high reward scenario for you guys to consider, right? And with Pepperstone, by the way, this is super easy. I believe, Marco confirmed to me, but like you can open up several accounts. It's not a problem, right? You open up,
not a problem at all.
not a problem. Super easy, right? And this is really kind of custom made for Pepperstone. So we have 10,000. I'm gonna do a euro example because I'm gonna use European regulation. We have a $10,000 euro account, right? I'm gonna create two accounts. The first account I'm gonna call bank, right? And the second account I'm gonna call trade capital. So what I'm gonna do is I'm only gonna drop 1,000 euros into my trade capital account, and I'm gonna keep $9,000 in what I call my bank account, right? Everybody get that? Next, I'm going to use the 25-to-1 lever, the maximum leverage allowed in the European rules. I'm going to get long euro, 250,000 euros at 115. Let's assume I was brilliant enough, and euro now is trading 117. I was really, really smart. So I'm long my max amount in that trade account, that $1,000 account that I put in there, right? So here's my position. It goes to 116. It actually now is trading 117. I made 200 pips, which is I made $5,000, right? I made a massively huge win. I dropped, I made $1,000 into my account, and I timed it perfectly. I was in the zone with the marketplace, and 100 pip move made $2,500, or 210% win on the trade, right? 1,000 euro, 25 USD. I can't believe I actually converted. I was studious enough to convert for this example. But anyways, the point being is, nice example, right? This is like awesome. I made a lot of money on my trade account, right? Now, let's take the other example, which is going to be very common. Oops, it didn't go my way. The trade went the other way. There was news on the stock. The market just turned around. I read the market wrong. Blah blah blah. So I drop 1,000. The automatic position closer makes sure, and again, I'm assuming we don't have a very, very unusual end of the world event where we have discontinuous trading. We almost always have continuous trading in the major currencies, right? I get stopped out at 500 euro. So in the worst case scenario, right, or even like the absolute worst case scenario, let's just take this as always, being a dark New Yorker, I always assume the worst. Let's say there is a discontinuous move and the euro complete just wipes out, right? I'm wiped out. But this is the thing. I am wiped out only on my trading account. I can't have more than a negative trade balance, right? So now, okay, the worst case scenario, I either have 95% of my money, I have 500 euros left and 9,000 in my bank, or 90% of my money, 9,000 in my bank as I'm wiped out in the account, right? Just the absolute worst thing that happens to me, I still got 90% of my money. That means both physically as a resource and psychologically as a trade, I'm in great shape. I don't care. The market, sticks and stones can hurt my bones, but words will never hurt me. Whatever it is, the market can't hurt me, right? Look at that. I kind of bulletproofed my my idiocy. And that, by the way, I think that's the motto of my life, is to bulletproof my idiocy. But that creates an incredibly interesting possibility, right? Either way, as we say in Las Vegas, winner, winner, chicken dinner. Nobody likes to lose money, but if I'm going to lose money, I certainly want to keep 90% of it when I'm wrong, right? So now it gets kind of interesting, because this is where this particular structure really helps you. Most traders really don't understand that they are constantly increasing leverage by making implied bets. Let me give you an example of what I mean. So let's say right now, I'm looking at the market and I went long euro dollar, long pound dollar, long Aussie dollar. You're looking at this and you go, oh, he's long 3 separate currencies, and so he's diversified, right? And Actually, nothing could be further from the truth. Now, in a current market environment, there actually is quite a significant amount of difference between euro and pound and Aussie, but it's not, it's certainly not non-correlative, right? So maybe this will move a little slower, this will move a little faster, this will move medium fast, but they will all pretty much move in the same direction, right? It's extraordinarily rare where this goes up, this goes down, this goes up and down, all the time. Like they all go their own different ways. It's extraordinarily rare where they, most of the time you would agree with me, they're all going to move in one way because this is not three separate trades. This is actually an implied big anti-dollar trade. You're basically betting the dollar's going to fall today, right? And if you make that trade at 10-to-1 leverage on each pair, so 10-to-1 euro, 10-to-1 pound, 10-to-1 Aussie, your aggregate leverage, in a fully correlated sense, is around 30-to-1. You've now actually tripled your leverage to what you think you're levered at. So, any questions on that? Because that's a very, very key component. This is, that's a very key flaw in logic that almost every newbie trader makes.
Yeah, we have a couple questions. The first one is, what if I put $500 in my trading account and a week later I'm up 500, so I have 1,000? Does the 50% margin close out be effective on my initial deposit, or which is 500, or does it now operate on my $1,000?
It operates on your $1,000.
Okay.
It's always whatever is the value of your account. If it goes to half, we're going to wipe you. We're going to stop you out. If you go from 500 to 50, this is a great question, by the way. So let me take that example to its extreme. You start with 500, right? And you're an amazing trader. You go on an incredible streak. You get like 20 trades in a row, and now that account is worth 50,000, right? You get insane amount of accurate trades, and each one of them at the highest possible leverage. Now it's worth $50,000, right? So now you're at $50,000. You think you're God, and you make the next trade, and it's a stupid trade. The market goes completely against you, and you're closed out. Where are you closed out at? This is a good question. So let's see if anybody can type in and tell me what would be the value of your account once you're closed out in that particular scenario. You go from 500 to 50,000. You make a stupid trade. What happens to the value of your account? See if anybody can. What are the answers that they're typing in, Marco?
We have one that says I wish. Then we have 25K, not the 25K, 25, right, which I suppose is 25K. Yeah.
Right. So that's correct. So think about that. This protects you from your own stupidity. You are still got $25,000 in your account when you started with 500. Now, before what would happen is you take $500, you run it to 50,000. You would get into a trade, right? It would be really, it would go against you. You keep dropping money, and you would give all of it back, right? Like none of it. You'd have the $500 that you originally started with would also be gone, right? That is like 99% of all trading stories I've ever seen about hot hands, about winning traders. No winning trader has ever been able to keep his winnings, right? As Warren Buffett says, it's not the money you make, it's the money you keep that matters. So yeah, yes, the answer is that this is why it's such a powerful tool in your favor. So this is my most all-time favorite, my most all-time favorite flaw that everybody makes, which is this is ridiculously correlated. Euro yen, pound yen, Aussie yen is essentially the same trade. It's the same frigging trade. Okay, I still remember like it was the height of the carry trade around 2005 or so. Like when Greenspan was really running U.S. rates, and the yen was just dollar yen just kept going to 125 and higher. And this guy comes in and he's like, look at me, I am up. This was the guy who was like, I started with 10,000, now I have 100,000. You suck. You don't know anything about trading. Your account isn't even half as big as mine. And I go, okay, let me look at your account. And the guy was like, long euro yen, pound yen, Aussie yen. He goes, I'm totally diversified. I have a portfolio of really great trades, and I'm gonna, look how well I'm doing. Needless to say, when the carry crashed, this guy went to zero, right? Like every other person. So don't be this guy. That's the key thing. Understand that this is the exact same trade, and you're completely over leveraged when you have those three same positions at the same time, right? And sometimes these are sort of obvious examples: pro dollar, anti-dollar, pro yen, anti-yen. But sometimes the correlations are not even obvious, right? Sometimes they're kind of like, risk on, risk off with some pairs versus others. Oil, yes, oil, no to Canada. Precious metals, yes, precious metals, no to Aussie. It's not easy sometimes to figure out the correlations, which is all the more reason why this trade model becomes valuable, because it protects you from the hidden risk that you may not see. Like, you may think, okay, I'm long Euro Swiss, short Euro Pound, and long Euro CAD, and one is a calm dollar cross, one is a risk cross, one is a Brexit story. But in the grand scheme of things, they may be all completely correlated for a whole bunch of reasons you don't know. And if you are not protected, your account gets blown out. I like this cartoon. I thought it was kind of funny, because it's all about assumptions. It says, someday I want to get married because studies show that married people are happier. A smart interpretation is that no one wants to marry an unhappy person, right? He goes, you're annoying. And it's true, that what you think is happening may not be necessarily be what's happening, but this protects you in a way. So here's some possible ways for us to trade the bank trade model. This is where we talk about, people were asking me, what's the best way to day trade? What's the best way to swing trade? So here I'm going to address my personal views of what I think is the best way to do both. So we have a bank account, right? Which is most of your capital. Position one, account one is positional trades, which means we trade with low or no leverage. By low, I mean 5 to 1 or less, but really maybe even 2 to 1 or less. Let's say no leverage is 1 to 1, and low would be 4 to 1 or lower, right? And in this particular account, we're looking to make 200 pip per trade. So it could be a multi-day, multi-week hold before we get a move. Sometimes it could be 3 or 4 weeks before we get a 200 pip move, right? Account two, which is swing trades. Here, the leverage would be 5 to 1 maximum, 5 to 1 maximum. And in the swing trade domain, I'm assuming you're going to go for that sweet spot of 20 to 50 pip targets. This is really where I think most people trade. And I think you should be trading at around 5 to 1 if you're looking for about a 50 pip target. It's a mental shorthand that I like to use is drop it by 10, right? So if I'm looking 50, then I want to drop, then divide that by 10, and you get 5 to 1 lever. The reason why, obviously, is because, remember, we talked about that whole idea of like getting 5, 6 trades in a row wrong. We want to have a small amount of total losses into our account. And 20 to 50 pip targets is basically the 1 hour to the 4 hour chart, which is what I think a lot of people trade. It's about either a half day's move or a full day's move in a currency. So all of those things kind of combine to me as a I think a reasonable factor for what kind of a lever factor you want to trade. Now here's the thing, you want to day trade, and this is my own personal. So I day trade. I'm probably I have the worst habits of everybody, which is I like to trade a lot. I like to day trade, and I trade. But when I do trade, my leverage is curbed completely, 100% to no more than 10 to 1, right? It's huge because what I'm basically looking here is 10 pip targets. So in this case, if I'm looking to make 10 pips, I don't want to go, again, same kind of a thing. I want to just divide it by 10 to 1 lever, right? That's my leverage for the account. So if just to review this, I would say 2 to 1 is maximum if you're going to look for 200 pip targets. 5 to 1 is maximum if you're going to look for 50 pip targets. And 10 to 1 is maximum if you're going to look for 10 pip targets. That's how I would structure my leverage, right? Now, those of you guys who like to trade trend, actually are perfect candidates for this bank trade model, for the bank account, trade account model, because trend is ridiculously low accuracy, right? I mean, trend traders are happy if they win 1/3 of the time. They're like, what's like the Australian equivalent of baseball? I like in baseball, in American baseball, if you actually hit the ball 30% of the time, you are considered to be a superstar. It means 70% of the time, if you lose, you strike out, you are a superstar, right? So trend trading is very much like that. If you hit 30% of the time, you're a superstar. It's a low accuracy, high reward strategy. And if you're going for 200 pips, very often you're only gonna make it 1/4 at a time, right? This is the story of trend trading. You're gonna miss all your targets, right? So this is where the trend strategy scenario I think is really, really interesting. We're gonna have $10,000 euro account. We're gonna create 2 trading accounts. First account is bank. Second account we're gonna call it trend capital, right? This is where it's kind of interesting because it's a combination of looking for large gains, but also kind of looking for large leverage. We're going to put $1,000 of our euro into our trend capital account and keep $9,000 in bank, right? We're going to go long. I'm going to use 100-to-1 leverage in this particular case, right? So long euro, 115, 100-to-1 leverage, because I'm going to assume, let's say Australian situation. So boom, we take a position. It goes quickly against us. $500 loss. We transfer $500 from the bank, and we're still bullish euro dollar. What we're looking for, basically, if you think about it, what is trend? You're looking for the currency to take off, and you know from charts how often you have false breakout. You have a breakout, and then just about when everybody's ready to give up, it becomes a true breakout, and it really takes off, right? In many ways, when we're talking about cable, well, I'm looking at cable right now, and you guys were asking me how cable. I think cable maybe this is after all these false breakouts, we may be having a real breakout, right? So here we go. So $500 from the bank, we get long euro again, right? Again, we get stopped out. Typical thing. Trade 3, again, we get stopped out, right? But we still continue to believe that the longer term trends are positive for the euro, right? 4th trade, finally the takeoff happens. The price really accelerates from our entry point. We're able to maybe put a stop to break even, and then just simply we'll let it float. It just continues. Maybe it takes 3 or 4 days, maybe it takes a week, but at this point we're at positive equity. It doesn't matter. We're floating profits, and we're just simply letting it go to our target. And boom, lo and behold, maybe about a week later, euro hits 200 pips plus our target. We finally, after 4 tries, we finally get a winning trade. So now here's what happens. Look at this. We got a $20,000 win on that one trade. That huge win. And we go back to our strategy recap. We had to drop 4 times from our bank account for a total of $1,500 euros in losses against $20,000 single win. Overall, we have $18,500 total on a $10,000 account. In our maximum drawdown, this is badly phrased, but what you say is maximum drawdown was only $1,500. We only are the worst resource we ever had was 85% of our money. So we kept 85% of our money in the worst time of this particular attempt of strategy, and we're able to make 18,500 on 10,000 when we finally hit the strategy, right? So of course it's an illustration. It's not it's not in any shape, sense, or form meant to give you a strategy. It's simply an illustration so that you yourselves can build your own intelligent strategies off of this. But it shows you, this is the single most important thing about all of this. It shows you how the bank trade model can control risk, can maximize leverage, can avert all those hidden correlations by basically, taking you out of positions when they all go against you if they happen to do so. And most importantly, how it can optimize trend trading, right? I think a lot of traders like to trade this way. A lot of traders would rather take small losses, but get a big hit versus the kind of way that I trade, which is taking lots and lots of small wins and occasionally suffering a larger loss. Because psychologically, and I think most people are much more trend wired, much more. Um, you know, it's like a job. If you're making 10 pips a day, it's like a job. But if you're making 200 pips a week, it's like trading, right? I think it just feels like trading. Well, the problem with that later model, trying to go for 200 pip moves, is that we're always subverted by market price action and by high leverage, right? We're our own worst enemies. The bank trade model completely flips that whole thing on its head. It says, yeah, go ahead. You can speculate intelligently, and as long as you segregate your money and you have a bank account and a trade account, and you trade, and you trade this way, I understand that all of it is artificial. I understand that essentially, you're just creating these kind of artificial barriers. But that's exactly it. That as human beings, we need those barriers to psychologically protect us from our worst instincts, right? And that's really what the bank trade model is all about. Now, in my own personal life, I have done this. I've taken it to complete extreme. I've created separate accounts for every single strategy. And then even within a strategy, right, I will separate an account for majors and an account for commodity dollars, right? And all of this, and this is just from my own perspective, like, so if I'm day trading, right, what I want to, my whole rule is I don't want to have more than 2 running trades at the same time if I'm day trading. Because let's say I have 2 trades, 10-to-1 leverage, that means I'm 20-to-1 levered. If I have a third or a fourth trade coming in, I'm just assuming a huge amount of risk for what I want to do, right? So by segregating all of this stuff, both mentally and financially, I've created this incredible bulletproof structure that protects me from my worst instincts. I had just Monday was the single worst day I've had in several months. Part of it was because I was traveling last week. I was in Canada last week, so this was my first day back. I really wasn't in sync with the market. I wasn't really figuring out what the hell was going on. But part of it was because the market was really difficult. I was doing a lot of counter trend trading, and the market was just in one of those rare 1 out of 20 days when it was just all trend, no retrace whatsoever. So I just kept losing money. Now in the old model, right, I would have been down 20%, maybe 30% in a day, because it would have been just one huge account, lots of leverage, big correlation. Nothing of the sort. I've already since Monday, I've recovered all of my idiocy, and I'm pretty much flat on the week, which is a huge win for me, all because everything was really, really segregated across all stuff. So I was making lots of mistakes, but there were small mistakes across different places, and I kept getting, taken out without hurting myself worse. That's the whole bank trade model in many ways. Now I'm going to leave it for you. Wow, I thought we were going to be short, but we actually really took up all the time. So I'm happy to hang out here. Any questions, any thoughts? Go ahead, Marco.
Yeah, we have one question. I think we have time for one. So is it not advisable to take correlated trades? We should just play strongest with weakest currency. How do we manage our risk in this situation?
So I don't have we're going to let the New York City sirens go by. It's not a Boris webinar unless you don't hear sirens, right? Like, that's the one thing you can bet almost 100% on all the time. I don't have a perfect answer for you, right? I have my own answer. My own answer is I don't want to have more than 2 correlated trades floating in my account at the same time. So my suggestion to you is, if you have an algorithm that maybe picks up 2 or 3 trades in the same direction of the same trade, stuff like that, a very simple way is what I like to subdivide. The most granular way is majors against com dollar. So I'll have an account that only trades euro dollar, pound dollar, yen, and Swissy. and then an account that only trades CAD, Aussie, and Kiwi, right? Another way that is maybe more for swing traders and more for positional traders is to have majors crosses. So you could have one account that is Euro, Yen, Pound, Aussie, CAD, Kiwi, Swissy, and then the other account is just all the crosses with that. So that again, you are segregating your funds and segregating your risk by that position. But as far as sort of your question to me, is it bad or good to trade non-correlated assets? It's really good to trade correlated positions if you're right. I mean, if you trading carry and wow, look at everything popped, beautiful. If you're trading, look at pound is going to go 32. Pound is going to go 32 today. So if you're trading like let's say the yen crosses and you go long pound yen, euro yen, Aussie yen today, you're a winner, right? Kiwi yen, you add Kiwi yen to that. You have 4 trades that are essentially the same trade, but they're all working. So the answer to that is it depends on whether you're right or wrong. But the way to minimize the situation when you're wrong is really not to have more than 2 at one time. That's my own personal rule. Any other questions you guys have? I'm happy to answer. But the most important thing, I just sort of want to make sure everybody understands, if you set up the bank trade model, which is one account, is the bank account does not trade. The bank account just sits there and is like a funding account. And then the trade account trades, and you have more, and you have obviously more than one trade account. You can have lots of trade accounts doing lots of different strategies. That creates the segregated structure that's both mentally, financially, and physically very, very protective. That's the most important thing that I wanted to kind of end the conversation with. Is there any other questions that we have there, Marco?
Yeah, we have one question. I think I can answer this for Charlie. What is the cable you keep talking about? Sorry, I'm a newbie. It's the pound.
It's the pound. Yeah, the pound has like lots of different nicknames, but the reason it's called cable was because this is the first financial instrument they traded when the transatlantic cable between New York and London was installed. So they used to trade the pound against the dollar, and that's why it's called cable. But go ahead.
Perfect. Last one. We have what is a recommended volume size for trades? 2% of the account. It's a little tricky, this one.
What is the recommended risk?
Volume size is it?
Well, volume doesn't matter, right? Because it's risk that matters. So let me give you an example. If you if I'm trading I have $10,000 in my account, and I'm trading 10,000 euros, right? Then and it's a 2% risk. That means it's a 200 pip stop. It's 200 pip stop, right? So I can afford to have 200 pip stop on that particular position because my volume is 10,000 against my equity of 10,000. But if I have the same position, $10,000 in my position, and now my volume is 100,000, I'm trading 10 to 1, right? And I only want to limit myself to 2% risk, then my stop is 20 pips, right? Which is literally, that's really how I trade. So my stop is 20 pips. I have $10,000 account, and I trade 100,000 unit position. Does that help to answer that question?
Yeah, I think so. It was pretty clear. I mean, I think we're done with the questions here, Boris.
Yeah. All right. Well, good. Guys, thank you so much. Next month, I'll be back. Kathy is traveling, so you're going to get a double dose of Boris. It's going to be a very interesting webinar, I promise you. But hopefully you guys really enjoyed this. This is, as I said, this is a foundational webinar. You really need to, this is foundational information that doesn't matter whether you trade trend, counter trend, positional, day trading, anything else. Understanding this piece of information is going to make you a much better trader for your life. So hopefully you guys enjoyed it. Any questions, obviously email me here at contactbk4s.com. I'm happy to answer them. And hopefully Marco will be able to get you the PDF of this if you guys need it, right?
Yes, it will be online shortly. So thank you, Boris.
Yeah, thank you so much, guys. I'll see everybody next month.